In the world of investments, two names often come up: the stock market and cryptocurrency. The stock market has been a cornerstone of global finance for centuries, a bustling marketplace where buyers and sellers connect to trade shares of publicly traded companies. From tech giants to fledgling startups, the stock market is a reflection of both the economy's health and the public's confidence in it. On the other side of the coin, we have cryptocurrency. These digital or virtual currencies operate independently of a central bank, using cryptography for security. They've been hailed as the future of finance, a decentralized and secure way to conduct transactions. Yet both these markets are known for their volatility. They've seen their fair share of bull runs and bear markets, making and breaking fortunes overnight. Both the stock market and cryptocurrency have their unique characteristics and risks, and both can be as rewarding as they are unpredictable. But which one is more volatile? Let's delve in. The stock market is nothing new. It's been around for centuries, serving as the economic backbone for nations worldwide. It's a bustling, vibrant marketplace where fortunes are made and lost in the blink of an eye. But with great reward comes great risk, and the stock market is certainly no stranger to volatility. Picture a roller coaster ride, a thrilling, adrenaline-pumping experience that has you gripping the handles, your heart pounding in your chest. That's the stock market for you. It goes up and down, responding to a myriad of factors, from economic indicators to geopolitical events. Let's take a walk down memory lane to some of the most tumultuous periods in the stock market's history. Remember the Great Depression of the 1930s? The stock market crash of 1929 was one of the major causes, with the market losing nearly 90% of its value. Fast forward to the turn of the millennium, the dot-com bubble. This was a time of irrational exuberance, with technology stocks soaring to dizzying heights before crashing down. The Nasdaq Composite, heavily laden with tech stocks, saw a precipitous drop of nearly 78%. Then came the financial crisis of 2008, a severe worldwide economic crisis that took a heavy toll on the stock market. It was a time of panic and fear, with the market losing over half its value in less than 2 years. And who can forget the recent COVID-19 pandemic? The global health crisis sent shockwaves through the stock market, causing a swift and severe downturn. But just as quickly, the market rebounded, driven by unprecedented fiscal and monetary stimulus. So there you have it, the stock market, in all its glory and volatility. It's a place of opportunity, of risk and reward, where the brave and the wise can find their fortune. But the stock market, as you can see, is no stranger to volatility. But how does it compare to the relatively youthful cryptocurrency market? Cryptocurrency, a relative newcomer, has taken the world by storm in just over a decade. Now, let's take a trip down memory lane to understand the roller coaster ride that is cryptocurrency volatility. It all started with Bitcoin, the first cryptocurrency, which was introduced in 2009. Back then, it was worth less than a penny. Fast forward to 2017, and Bitcoin had skyrocketed to nearly $20,000. This initial boom was fueled by widespread speculation and the allure of a new digital gold rush. But as quickly as it rose, it fell. In 2018, the cryptocurrency market experienced a significant crash, often referred to as crypto winter. Bitcoin's value plunged more than 80% from its peak, and many other cryptocurrencies followed suit. This drastic drop was a harsh wake-up call for many investors, reminding them of the inherent risks and volatility in the crypto market. Yet, despite this crash, cryptocurrency didn't fade into obscurity. Instead, it bounced back. In the year 2021, we saw a resurgence, with Bitcoin reaching a new all-time high of around $65,000 in April. This resurgence was driven by various factors, including the increased adoption of cryptocurrencies by mainstream financial institutions and the rise of decentralized finance, or DeFi. Furthermore, the emergence of new cryptocurrencies like Ethereum, Ripple, and Dogecoin, each with their unique selling points and use cases, has added another layer of complexity and volatility to the market. In summary, the cryptocurrency market is highly volatile. Its value can skyrocket or plummet in a matter of days or even hours. This volatility is due to a variety of factors, including market speculation, regulatory news, technological advancements, and broader economic factors. Cryptocurrency has seen drastic highs and lows in a relatively short span. But how do these two markets compare? So buckle up as we delve deeper into the comparative analysis of stock market and cryptocurrency volatility in the next scene. Now that we've understood the volatility of both these markets, it's time to put them head to head. Let's start with the stock market. The stock market has been around for centuries, weathering everything from wars to economic recessions. It's a mature market, with established mechanisms in place to manage volatility. For instance, there are circuit breakers that pause trading if a stock's price moves too drastically in a short period. These are like safety nets, preventing a free fall. Factors that contribute to stock market volatility include major economic indicators like unemployment rates, GDP growth, and interest rates. Market manipulation, while illegal, can also cause volatility. Insider trading or spreading false information to influence stock prices are some examples. However, regulatory bodies like the Securities and Exchange Commission actively work to prevent such practices, adding a level of security to this market. Now let's shift gears to the world of cryptocurrency. The crypto market is much younger, having been around for just over a decade. It's like the Wild West in comparison, with its lack of regulation and relatively new technology. The volatility here can be much more dramatic. The factors contributing to crypto volatility are somewhat similar to the stock market, but with a few twists. Market manipulation is also a concern here. Pump and dump schemes, where prices are inflated artificially only to be sold off rapidly, are not uncommon. Technological changes and advancements can cause significant price swings too. Take for instance, when a popular cryptocurrency undergoes a hard fork, creating a new version of the currency. This can lead to rapid shifts in value. Regulatory news plays a huge role in crypto volatility. A mere tweet or announcement about potential regulation can send prices soaring or plummeting. The lack of a centralized body overseeing the market adds to this volatility. It's also important to note the influence of sentiment in the crypto market. The value of cryptocurrencies is largely driven by perception and speculation, more so than traditional economic indicators. This can result in sudden and extreme price movements based on news events, social media buzz, or even celebrity endorsements. So, when we compare the two, it's clear that both markets have their fair share of volatility. However, the crypto market, with its less regulated nature and reliance on sentiment, can experience more dramatic swings. The stock market, while not immune to volatility, has more safeguards in place to manage it. But here's the kicker. Volatility isn't necessarily a bad thing. Yes, it implies risk, but with risk comes the potential for high reward. It's this very volatility that can provide opportunities for significant gains. And that's what attracts many to these markets in the first place. In terms of volatility, both markets have their moments. But remember, with greater volatility comes greater risk and potentially greater reward. So there you have it, a look at the volatility of stock market and cryptocurrency. We've journeyed through the intricate world of financial markets, unraveling the concept of volatility in both realms. It's been an intriguing expedition, wouldn't you agree? Remember our discussion about the stock market? We explored its fluctuating nature, how it's influenced by a myriad of factors from corporate earnings to geopolitical events. It's a market that's been around for centuries, weathering all sorts of economic storms and still standing tall. Then we ventured into the realm of cryptocurrency, a market that's relatively new but has captured the world's attention. We discussed its volatility, how it can surge to astronomical heights one moment and plummet the next. It's a market that's decentralized and largely unregulated, making it exciting and daunting. We've also drawn comparisons between the two. That while they may seem worlds apart, they share the common thread. Both markets can offer significant returns, their fair share of risks. To remember that high risks often come hand in hand with high risks. What does this all mean for you? It's essential to remember that we are financial advisors. This video is designed to inform and educate, to provide financial advice. A unique set of risks and rewards, and it's crucial to before diving in. Do your own research, consult with professionals, align with your financial goals and risk tolerance. The world of investing is a thrilling journey filled with opportunities and challenges. Whether you choose to explore the traditional pathways of the stock market or venture into the uncharted territory of cryptocurrency, remember to navigate with caution and wisdom. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notification so you'll get updates anytime we upload a new video.